Hi, welcome to nestegg's monthly ETF update for July, powered by ETF Securities. We're joined by Kanish Chugh. How are you going?
Not too bad. Yourself?
Yeah, no, I'm really well. Let's get going. How did the ETF market fare in July?
So the ETF market grew by 2.07%. So it currently sits at about $39.7 billion in terms of size across 179 products. It's all $484 million of inflows for the month of July.
Which ETFs within that had the biggest inflows and which ones had the biggest outflows?
The largest inflows was actually by the Vanguard Australian Share Fund, VAS, that had close to $46.4 million in inflows, and that was followed closely by the SPDR STW ETF, another broad Australian equity benchmark. In terms of outflows, it was actually the BetaShares Cash ETF, AAA, that had nearly $86 million of outflows, and that was then followed, a fair bit behind, but followed by two resource equity ETFs from both VanEck and BetaShares.
Do you have any thoughts around what's actually driving those movements?
There isn't much sort of insight that we're gathering at the moment, but it could be from where we sit, maybe a bit of positioning from clients just before reporting season. Mm-hmm. And in terms of obviously the outflows in cash, that's indicative of possibly a particular client, institutional client, obviously taking some money away from cash and repositioning across portfolios.
Moving to specific groups, Fidelity recently launched its first free index fund. What does that mean? So
that was in the US. That was interesting to see. That's the very first zero-cost index fund, both across unlisted and ETF space. So there's still no ETFs that are zero cost. Essentially, why did they do that? So that was a self-licensed index. So they're not paying any index provider like S&P or MSCI any index fees to track a benchmark, and that's one of the big components of an ETF's cost in terms of when they launch a passive ETF. Also, it could potentially be a marketing play. So obviously, the idea of in the supermarket, you have the low-cost milk, you attract the customers, and then you possibly will buy higher margin products. In the same way for Fidelity, if they're offering a low, zero-cost product, get the customers in the door, and then they can cross-sell them into one of their high margin active funds. Mm-hmm. There's also other internal revenues that can be generated from some of these managers like Fidelity. For example, they can do some security lending on the underlying stocks that are held within those index funds, potentially some trading and cost efficiencies that they may be able to maintain.
It'll be interesting, at least from my perspective, to see how that move trickles down, whether it does trickle down.
Yeah, look, I think you will eventually see a zero-cost ETF, possibly in the US and in Europe before you will see it here in Australia. Overall, we are, though, seeing a trend downwards in fees, both globally in Australia as well. You're obviously seeing more competition. That's the sort of interest from clients. We're wanting to make sure that we come out with the most cost-effective way to provide some of these asset class exposures. And you already saw that with BetaShares launch the lowest cost Australian equity exposure around the world at 7 basis points. So it will be in due course that you will see that, but I think it will take some time in Australia, and you'll probably see it from some of the larger providers globally, such as iShares and Vanguard, because they have the scale to be able to launch such products.
Mm-hmm. Fair enough. Well, speaking specifically about Australia then, ASIC recently put out its exchange-traded product report. What were your main takeaways from it?
Yeah, it was interesting. I did read that, and essentially it put a bit of warning on the ETF providers, so issuers such as ourselves. Mm-hmm. Essentially, it said that we need to make sure that we monitor the spreads of our products, making sure that they're competitive, that they're as tight as they can be. So that involves us monitoring the products, speaking to the market makers, engaging more market makers to be involved in some of our products and making a market for them, and also generating awareness and exposure on our ETFs to make sure that there's increased trading. And that's also a natural way to tighten spreads. It also spoke about ETF providers looking at the asset gathering of some products and those funds that aren't gathering assets quick enough. And you can see some funds there that have little to no AUM in them. And for where we sit, we factor that into our product development and put out a long-term view for some of our products, and we're constantly monitoring that and obviously trying to promote these funds. But it's just something to keep in mind. As long as a fund has underlying liquidity, so the underlying exposure is actually liquid, then the clients can trade in or out of the fund as they need to.
This is something that I've been wondering. How long does it take for an ETF to really find its legs, to really gain its momentum?
Yeah, so that varies between product to product. To give you an example, our Robo ETF, which looks at robotics and automation, that launched in September last year, and we're now sitting in August and it's gathered $115 million, and that's the fastest growing thematic product. Where on the other side, you may see some niche exposures or broader exposures that, because of the current market situation, the market environment, they don't gather as many funds as something like that robo ETF. So I think you need to give an ETF time, so minimum is 3 years, and that essentially should allow certain products to some time to show some success. But for some of the broader equity exposures, you need to also give it the ability to go through all the different cycles, so even 5 to 7 years for some of those products. More recently, we saw iShares actually close a number of their funds, and the rationale for that was commercial aspects, so competitiveness around other products, and also duplication with their own products, but also competitors. They closed a Russell 2000 ETF, and they have a mid-cap US equity product and also a small-cap US equity product. So there's some cannibalization there occurring within their funds. So they thought, okay, it makes sense to do that. ETF Securities, we have also closed down some funds, both from a commercial reason because we didn't see future commercial success, but we gave those funds enough time to succeed.
Yeah. My takeaway from that is that it has to be in preschool or reading those little books, in year 2, basically.
Yeah, fair, yeah, exactly, yeah.
Well, that's everything for this month. Thanks, Kanish. Thank you also. That's it for July. See you next month.